guys, Brian Stevens here with Mortgage Shots of the National Real Estate Post, coming to you on a Monday, and boy, do we have something to talk about today. As you probably heard last week, Fannie Mae is doing away with credit scores. That's right, Subprime is back. Anybody with any credit score who could fog a mirror can go ahead and get a Fannie Mae loan. Wouldn't that be nice if it was that easy? Okay, so Fannie Mae is removing minimum credit scores, and they're doing this for DU. The current 620 minimum credit score is a representative average or median credit score. It will be removed for new loans case files created on or after November 16th, 2025. So you can go back through with your clients, or you get new clients and you have a 600 credit score, and you can go ahead and take a run at Fannie Mae and Freddie Mac. Word to the wise, they're not doing 620 credit scores right now, so I don't think they're going to be doing 580 credit scores tomorrow. The mortgage industry is debating changes to the loan level price adjustments, focusing on affordability versus risk. While some advocates for lowering fees to boost affordability, others warn of revenue impacts amid a potential Fannie and Freddie stock offering. Well, I mean, they're going to lower the credit scores right at the same time they're talking about doing a public stock offering and the government taking a backseat. You see, right now, the United States Treasury basically, by and large, owns everything Fannie and Freddie. Now, they're going to forego their shares, get rid of their preferred stock, and they're going to give ownership back to those who've invested in Fannie for decades and decades and decades. At the same time, they're going to take the onus of responsibility off of their shoulders over at Fannie Mae and Freddie Mac. They coincidentally say, hey, listen, we'll write a loan for anybody now. You can have a 520 credit score, and Fannie and Freddie will do that now. Okay, this is your purchase money loan level price adjustments by credit score and loan to value. Up across the top is our loan to value. So let's say that we want to go 80 to 85% loan to value, okay? And let's say we have a borrower who has a credit score of 640. So what we have to do is we have to get our matrix and we have to go check out and see what that add is going to be. As you can see here, that is going to be a 2.5% hit. And that's going to be a hit to your fee. What that means is that you're going to have to pay significantly more. Now, if you have a credit score that is 639 or lower and an 80% loan to value, you're going 80 to 85% loan to value, you're going to be right here, which is a 2.875 hit. If we go 75 to 80%, here's what our hit is going to be. If you have a 80% loan to value with a 630 credit score, you have to pay an additional 2.75%. However, if we were to go to 90% loan to value, 95% loan to value, you have a 1.75 hit. That doesn't even make sense, does it? Okay, so if this is our case and we're going to go 80% loan to value and we 75 to 80% loan to value, we're going to have a 2.75% hit. The question I have to ask is, if we are going to go below a 639 credit score, how much additional hit are we going to get with the loan level price adjustments, even if they choose to do it? Because Fannie and Freddie, they are going to do this. If they're going to guarantee a riskier loan, they're looking for more money in return. More risk, more reward. With that risk also comes the possibility of complications or defaults, and defaults could have a massive impact on Fannie Mae and Freddie Mac's reserves that they receive through the G fee. That G fee, or a guarantee fee that they charge, and the money that they make from the loan level price adjustments are intended to go to those who invest in mortgage-backed securities that are backed by Fannie Mae and Freddie Mac's implicit government guarantee. So if you get foreclosed on and that investor loses out on $50,000, Fannie Mae pays $50,000 to make that investor whole. That's the idea. So is this well thought out? I think probably not. Now, if we go down here, of course, we have the same type of thing. We have additional ads on top of these ads. So if you have an 80% loan to value with a 630 or lower credit score, you have a 2.75% hit. Let's say that it's also a condominium that you're going to live in, provided you can still buy a condominium. And we have to go over to our 80% loan to value, and you're going to see that we have, or a 75 to 80% loan to value. Then you can see we have an additional 0.75 hit on that property. So we have the 2.75 here, add another 7.5. We're sitting fat and happy, aren't we? At 3.5%. You're going to be sitting fat and happy, adding 3.5% to the price in order to get the rate that you're looking for. Again, somebody getting a condo, maybe got money from mom and dad, credit score's not so good, you're going to take it on the chin, and that rate is going to be significantly higher. Again, that's if you can find a lender who's going to write this loan. And I'm telling you right now, if you do, you're going to be spending an exorbitant amount of time on trying to get these deals closed, because that's kind of how it works. Loan level price adjustments, it's the same type of thing over here. What you're looking at here is a cash out refinance and the cost on that. And then you have a limited cash out refinance, which is also known on the bottom here, a rate and term refinance. So your rate and term refinance, you get your ads here. And then if you're going to pull cash out to fix your house up, here's some additional ads. As you can see, this can get expensive. And of course, down here is we have loan level price adjustments that are going to be a benefit to your client. Now, this is if they've done some home counseling for home ready, home style, and their energy efficiency. Refi Now loans, this is specifically not refinancing a loan. The program is called your Refi Now loan. All are going to pay your borrower back $500. If you have a home ready loan to a very low income purchase borrower, defined as 50% of the median area income, the area's median income, where at least one borrower is a first time home buyer, you get $2,500 cash back. Hardly enough to offset the costs that we're going to incur over here that are added. So we add money that the borrower has to pay, we subtract money, and that's how we find what your adjusted interest rate is going to be on all of your Fannie and Freddie deals. It's a pretty interesting graph here. This is consumer sentiment. This is how your clients feel about the market right now. All consumers collectively, it's as low as it's ever been, and independent consumers, yeah. So we can hear during the election cycle we just saw last week how everything is going great. But the truth of the matter is your clients right now are very bearish when it comes to owning homes, and the fact that properties aren't moving and that sellers are holding on to their prices. This is enough to keep anybody on the fence and make them depressed about any future outlook to buy a house. New construction premiums vanishes. Prices for new homes, home builders are going away from trying to incentivize you, and we talked about this yesterday. There's some builders who are offering 1% interest rates on mortgages. Do the math on that one. And they're still finding that people are on the outside looking in, and they're not biting at the sales prices that we currently have. Buyers believe prices are going to come down, and you can give them a 1% interest rate, and they don't want to buy the house unless prices come down. You need to understand that when you're talking with your clients. You need to understand that, especially if you're a listing agent and you're going out there and listing a property. You're going to have massive pressure from your sellers to go ahead and list that property higher, or maybe what the Zestimate says. But the truth of the matter is buyers are on the fence and they don't care what interest rates are doing. So new home construction, what are they doing right now? Well, they're pricing new homes. They have fallen below resale for the first time ever. Our buyers out there, our independent buyers, are holding onto their prices more than new home builders. Again, I've talked about this before. I blame Zillow. I put this in here just because I found this absurd. I don't know anything about it, but Tesla shareholders approve $1 trillion pay plan for Elon Musk. Tesla shareholders approved CEO Elon Musk's historic pay package at the company's annual shareholder meeting in Austin, Texas. The company said that the proposal received 75% supporting votes from the shareholders, and Tesla introduced the package in September, and that's exactly where we're at with it. $1 trillion. Okay. Put it in the comments down below. Kind of curious. Does anybody really need $1 trillion? It's amazing. It's crazy. All right, the average FICO score. We talked about this a moment ago. FICO scores are higher today than they've ever been. If we go back to the year 2000, Y2K, we had an average credit score that was about 688. Now the average credit score is 716. People do not change their habits. What happens is the credit scoring models turned that 675, 678 bar, they turned them into a 716. But it's still the same bar with the same spending habits. If you don't like credit scores being as low as they are, all you have to do is change them for everybody across the board. I don't know how this helps anyone, but what I do know, as I told you before, that person who has a 500 credit score today, a couple of generations ago, they were in the 400s. Mortgage borrowers in the United States have an average credit score of 758 as the second quarter of 2024. This is according to data from Experian. This puts them more than 40 points ahead of the national average credit score of 715. Ain't that interesting? One of the benefits of owning a house is you generally get a bump in your credit scores. Just as credit scores have broadly trended upwards for several years for all consumers, so they have for mortgage applications as well. Since 2016, average FICO credit scores for all consumers rose from 699 in 2016 to 715 in 2024. This is according to Experian. Meanwhile, those with mortgages in their credit file saw a similar sized increase from 739 in 16 to 758 this year. We're cooking the books on credit scores, guys. That's why offering even lower credit scores is kind of shocking that the GSEs would come out and do this, but it stands to reason they're doing it when they're taking the responsibility for covering those future defaults and they're putting them on the shoulders of Joe and Jane, investor/taxpayer. Okay, credit score averages. Check it out. Jumbo loan 768, conventional 738, FHA 645. Look how much lower FHA is than everybody else. That's why FHA, if you want to find out the direction this market is going to go, look to FHA borrowers. They will be the first ones coming out of the gate with foreclosures. More so than non-QM. Isn't that interesting? Your average non-QM borrower has a credit score well above 7, and they have the similar type of down payment capabilities as those with jumbo and conforming loans. Credit score by age. Got it figured out by the time you're 60 to 78. Gen Xers, those are people 44 to 59. That would be me. 661 credit score. Millennials, the same thing. And then your Gen Zers still have those college credit scores. Hey, listen, guys, do me a favor. Reach out. Again, my name is Brian Stevens. If you have any questions, by all means. Reach out to me. Put a comment down below. Give me a call. Better yet, send me a text. Of course, if you want to hear about being on our team, because we do marketing a little bit differently, yeah, let's have a conversation. If not, go to Mortgage Shots. If you subscribe to Mortgage Shots, you'll get my daily show, about 5 to 8 minutes. It's kind of this condensed a little bit. It'll be delivered to you every day. And you do with it what you choose. I hope you share, subscribe, and keep conversations about real estate going, because as I told you yesterday, we are in desperate need of great real estate agents and loan officers who will go out there and train and educate borrowers and dispel the misnomers about what's taking place in mortgage lending and real estate today.